This is Capitalize Your Finances, the show representing you, a select group of excited, ready, and fired up listeners seeking to potentially maximize your money moves and get after it. We don't settle for generic advice of always and nevers. Our currency is our intellect, and we constantly seek the logical way of likely creating advantages to potentially maximize wealth for our personal and unique situations. The show brings you this step-by-step framework to capitalize your finances in the aspects of your financial situation, and we strive to explore strategies and ideas to potentially help you capitalize on your financial decisions. We are capitalizers, and this is our show.
Welcome back to Capitalize Your Finances. As always, I'm your host, Christopher A. Paniotu, the Cap and Capitalize. And today we have a very special guest that I have been looking forward to having on the show for many moons now. He is the author of Where the Money Is, Value Investing in the Digital Age, founder of Gravity Capital Management, and legendary investor, the Adam Seessel. Adam, welcome to the show.
Chris, thanks for having me.
Absolutely. And I will say on the record, because last year, for those that follow me on social media, I read 21 financial related books, and this is going to sting to the other 20 out there, but your book was the favorite one I read in 2022.
Well, thank you so much. I appreciate it. I saw it on the top of your list there on the LinkedIn, literally on the top of your pile. So I'm glad that was metaphorical as well as literal.
You know what's funny? I totally didn't even recognize that until you brought that up. So enough about social media. We're here to talk about you. But before we dive into your incredible book, your amazing career, and then some financial nerdiness along the way, let's take a moment to take a trip down memory lane. What got you interested in investing in the first place? Was there a particular moment? Was there a series of moments or people? Enlighten us.
Well, it's a good question, Chris. You know, I always thought I was going to be a journalist. And so right out of college, I started as a newspaper reporter and then got into investigative reporting and did a lot of good in my 20s. Got people convicted of crimes and won some prestigious national investigative reporting awards. But I was always somewhat business inclined. My wife was a photographer at the paper that we worked at, and when the staff used to have business meetings, I would always be on the publisher with business ideas, even though I was a journalist. So she knew before I did that I was cut out for business. So okay. 25 or so years ago, so that was definitely one moment where it was obvious, at least to her. And then 25 or so years ago, I was, still doing journalism, but getting more and more tired of it. We were getting ready to have a family, and I thought, journalism does not pay much. The hours are horrible. Let me think about Wall Street. And I had friends who'd gone on to Wall Street at the height of the 1980s bull market, and one in particular said, Adam, being a financial analyst is like being a journalist. Just with different methods and different aims, I can't tell you how right he was. He helped me get onto Wall Street, which was not hard to do in the mid 90s because it was still the bull market was raging. But basically, as a reporter, you're combining document-based research, sitting and reading rather dry, boring documents, with human-based research, which is interesting and lively. But if it's not paired with a knowledge that comes from reading, then all the human-based interaction is kind of like gossip because it's not informed by a deep understanding of the material. On the other hand, if all you do is read documents and you don't talk to the humans, you have a very dry, inorganic understanding of the material. So really synthesizing the document-based research with the human-based research is what really makes things hum, and that's equally true of investigative reporting and investing. So the parallels are incredible, and I haven't really regretted a single day of going onto Wall Street, and in many ways this book was sort of marrying my original profession of journalism with my second profession, if you will, as an investment manager.
Sure. Well, in the second you started diving into the journalism side, I didn't want to assume, because you know what happens when you assume. Nothing is good. But I immediately jumped to, almost like forensic accounting, like investigative work, which has probably led to you being the investor that you are, as far as being incredibly diligent, thorough, all of those good things. So let's hop, skip, and jump a little bit through your years. You were at Sanford C. Bernstein, Barron Capital, Davies Selected Advisor. As a side note, all of these finance companies' names are super cool. Okay, but before starting your own firm, what were some of the major lessons that you learned from each one of those checkpoints?
Yeah, well, I kind of deliberately chose the different waypoints along the way as best I could. I didn't choose the first one in the sense that was the Bernstein offered me a job, but it turned out to be it's sort of I had no idea at the time, but it's sort of a prestigious investment firm, very steeped in rigorous research, famous for their black books, 150, 200-page, thick tomes of research on industries. And I was thrown into that culture, and it was great. And they're deep value investors, or they were when I joined. Super cheap stocks focused on, cheapness as the primary driver of value. So I was, schooled as a green young analyst in deep value, price first. And then I went to Barron Capital, which I didn't realize at the time, but it was great because it was the 180-degree opposite. Ron is a great investor. I've learned a ton from him. He understands what makes a great business and a great manager, but he's not so sensitive to price. So it was like going from a super price-sensitive firm to a firm that was not very sensitive to price and focused more on business and management quality. And then my third and final stop was at Davis Funds, as you said, which was sort of a Goldilocks in the sense that they were attentive to price, but they also wanted quality businesses. So by the time I'd gone through those three firms, I felt like I was ready to start on my own, especially since I had done oil and gas at Bernstein, I'd done financials and energy at Barron, and I did consumer products and media at Davis. So I was the specialist for several different sectors. So I'd had a sort of a tour of Wall Street sectors, if you will, and so felt like I was prepared enough to go off on my own.
And that just spurred up a question, because every checkpoint you had along the way, like you said, there was a specific sector, where it's oil and gas or utilities or advertising, you name it. And by the time you got to Davies Select Advisors, DSA for short, did you get to this point where you started to see opportunities and you wanted to spread your wings outside of the box and let the golden goose sprout his wings, if you will?
Yes, very much. I another thing my wife saw well before I did was that I don't like working for people.
Okay.
I was always rebellious in an organization. So, when I finally said I wanted to start my own business, she basically said, what took you so long? So, yes, I was very much ready to spread my wings, and I have not regretted the move ever since.
Sure. Well, was there a particular moment that made you decide? Obviously, you said in general, hey, I saw all of these sectors, I want to spread my wings, etc. But was there a specific moment, like a day or a person, where they told you and it clicked, like, hey, I need to go start Gravity Capital Management?
No, not really. It was more a gradual awakening and an increased bristling regarding authority and what I can and can't do. And, I wanted to set my own rules. And as anyone who starts a business will tell you, once you're the boss, the buck stops with you. So you have to stop complaining and start taking responsibility, which is a double-edged sword. Because,
right.
I've pretty much made every mistake in the book in the 20-some years that I've been running Gravity. But fortunately, the performance has done pretty well, and my clients have hung with me, and I'm still surviving, knock on wood. But experiences can be a hard teacher, but so I exposed myself early to the joys and pain of entrepreneurialism.
Yeah, well, it can be a painful lesson, but it's a valuable lesson nonetheless. So when you started Gravity, first off, how long did it take you until you hired your first employee? I'm just curious.
Oh, a long time. I like working by myself, and investment management lends itself well to solitariness, similar to investigative reporting. Um, Buffett's famous comment is, you couldn't pay me enough to hire an analyst, because
Right.
he feels like he wants to do the analysis, and I'm the same way. What are people paying me for, if not for my own judgment and investigative skill? So, gosh, I was on my own for a good 2 years before I took on a junior partner. Yeah. And then,
Nope.
after 4 or 5 years, that wasn't working out, so I went back on my own. So I've man- I've managed as much as a dozen people, and as few as just a single practitioner. So I kind of go up and down, as the needs require of my business, but also, in terms of how much I'm really prepared to deal with the hassles of managing people. Because
And so,
investment management is a great business in the sense that you can outsource everything. You can outsource legal, you can outsource compliance. The only thing that I refuse to outsource is investment research, which is again what people pay me for.
right, right. Well, yeah. I mean, if you outsource that, there's not a lot. There's not a lot left.
Yeah, then
Um,
you really shouldn't be collecting any fees.
sure, absolutely. So, how many people now, as of today, work for Gravity?
Me and one analyst.
Okay,
Two.
good. Because if you had 12, I would, if your employees were listening, I'd say get ready to pack your bags
Yeah, right.
because the corner's coming.
Right, right. No, yeah. So
So
I mean, two on the payroll, me and one other. But really, I have a lawyer that I consult with regularly. I have an IT guy that I consult with regularly. I have compliance people who keep my nose clean with the SEC. So I have people, but they're not. They're all outsourced with their own businesses, which I like because they run their own businesses, and so, our interests are aligned. They're business people. I'm a business person.
right,
It's much better than having employees who sort of, don't want to take the risk and reward associated with running their own business.
sure. Listeners of our podcast know that I like to coin myself as a master of outsourcing. I'm not going to say I'm a master of outsourcing, but I do love the process and procedures of outsourcing. Now, for Gravity, and you had kind of head start because you've had all of these awesome jobs along the way that gave you a tremendous um, floor of intelligence within the business. But even with all that being said, I don't care who you are. When you start a business, it is hard. And so, can you remember the moment where you turned the corner in life, financially speaking? And what was that moment like? How did the money game change for you and your family specifically? Or did it at all?
It's a good question. I mean, look, as I said, I've made every mistake in the book. There have been lots of twists and turns. I realized fairly early on that, this wasn't as easy as it looked, and that I was going from an armchair quarterback to an actual quarterback, and that was hard. I wouldn't say there's been a transformative moment. It's just been a gradual process of getting better and kind of 2 steps up, 1 step back. And, it's an interesting business because you're learning something every year, and just when you think you've got it figured out, things change. I feel pretty steady right now under my feet. But as I say in the book, 5, 6, 7 years ago, in the middle of the last decade, everything was working great with my traditional value approach, and then it very suddenly stopped working. So I had to reevaluate, from the bottom up, from the studs up, what I was doing and why my performance wasn't, doing as well as it had historically, and it was a real earth shaker. So those things come along, and you really have to, dedicate yourself to doing it. So I've done it. I feel good about my new formation and foundation and process now. But who knows? In 5 or 10 years, I might have to do it again.
Yeah, we'll have you back on in 5 and 10 years,
Yeah.
and you'll say, "Hey, Chris, whatever I said 5 years ago, scrap it." Well, and speaking of the book, let's switch gears to the book because I have a ton of questions to ask. One of my favorite messages in your book, and now of all time, it's from one of your early newspaper mentors, Pat. Is it Stith?
Stith. Yeah.
Okay.
Mm-hmm.
Okay. So I'm always sensitive with last names because no one can ever get mine. So.
Yeah.
So Pat Stith said, quote, "Sooner or later you get to be known for who you are."
Yes.
Now, from your perspective in the investing landscape, would you say that crazes like the meme stock craze or other crazes are finally being revealed for who they are?
Yes.
Okay.
The answer is yes.
Yes, and to give people context, this is being recorded in January of 2023, so we've seen a little bit of that. Do you see?
And I will point out in the book that in May, which was published in May 2022, I was rather scathing about the meme stocks.
Yes. And one of the things that I love, one of the many things I should say that I love about your book is you speak very common sense, and even the things that are very complex to, I'd say, like everyday people that want to get into investing, not really planning but investing, it brings you back to, okay, here's the complex term, let me break it down. Oh, and by the way, this is exactly how I feel about it, so there's no sugarcoating, which I love.
Well, that's a characteristic of journalists. You know, you're trained early as a journalist to simplify, and when you write, you can't BS. You have to either you're saying it clearly or you're not. And if you can't get it to your satisfaction, then your editor will tell you this isn't clear. So, but I appreciate you saying that because, the individual topics I tried to make simple, the complex ones simple, and the very, theme of the book is a very complex topic that I tried to reduce to simplicity, which is basically, look, value investing, this tradition that Ben Graham started 100 years ago, has generally worked because there's a set of rules, and that those rules were passed down to Warren Buffett and then passed down to him to people at Sanford Bernstein on to me. So there's a lineage, almost a religious lineage of value investing, and that's a wonderful discipline. On the other hand, in the last 10 or 15 years, there's been this enormous disruption in the economy, with a move toward digital stocks and software-based stocks. And these stocks, these businesses don't operate at all in conformity to any old rules. Old economic rules like the industrial age. These don't look like General Motors and Ford. Alphabet and Amazon and Microsoft don't look like those companies, nor do they conform to the old value investing principles and the rules. So there are these two big things that have collided, which is the age-old discipline of value investing with the very new realities of the digital economy, and how do you reconcile those two? That's what I struggled with personally 6-7 years ago when my performance started to suffer, and that's what I tried to articulate in the book: how to resolve these two big ideas.
Sure. Well, and before we dive into more of those big ideas, and specifically BMP, which, again, the tattoo is to be determined where that will be. Now, I have questions regarding where to start on the investment landscape. So I'm just going to be vulnerable personally amongst myself. So I'm on the planning side. We outsource to investment teams and all that good stuff, and I love them to death. But it's always fascinated me on the investment side of things. And I'm blessed that I had and still have an incredible mentor on the planning side that basically set the foundation and framework, which is now grown into what is known as capitalizing your finances. But from an investing standpoint, I don't know where to begin. I read books galore last year in 2022, but there isn't really a basic framework to at least get started. So I guess my question was, where would you guide someone like me or anyone to start?
Well, as I say in the book, Chris, it's best to start with what you know. They say, to writers, they say, write about what you know. And I would say the same is true for investors. Not necessarily invest in what you know, but begin to investigate potential investments in what you know. So, if you use your Apple iPhone, then you should look at Apple. If you really love Google search, you should look at Google. If you really use Amazon, you should look at Amazon. Now, all those are well-known stocks, but that shouldn't preclude you. In fact, I opened the book by talking about a buddy of mine from college, a Greek American, who just decided to put most of his net worth in Apple when the iPhone came out because it was a good product, and
Sure.
That's turned out well.
Sure.
So, but then if you go down another layer, it's maybe even more interesting because, as I mentioned in the book, like if you're in sales, you'll know if Salesforce, for example, is the killer app, or if there are other lesser known companies that are coming up to disrupt Salesforce. Or if you're in HR, you'll know whether Workday has got a lock on that market, or whether they're better, nimbler competitors that are going to disrupt Workday's business. So start with where you are and start in your particular own, what Buffett calls circle of competence. So I write in the book about a poker playing buddy of mine who is an auditor, and he works with large data sets. And he loves this company that basically helps him manipulate large data sets called Alteryx. I'd never heard of the company, but he loves it. He swears by it. And so I helped him think through the process of, the investment process, and then he owns a lot of the stock. So start with where you are, and in particular, mine your own niche of competence, because what percent of people know about Alteryx? A very, very small amount.
Sure. Well, and even extrapolating on that a little bit, and you spoke about this in the book a pretty good amount, but the curiosity I have, and even before I read your book, there was a curiosity I had because investors that you listen to, like for example, Warren Buffett has been around literally almost 100 years. Mm-hmm. And some of the stuff that, if you go back 30 or 40 years, it's kind of hard to understand, at least for, younger investors, because we weren't even a thought mm-hmm. when he was speaking about this. But then it's this very philosophical idea, and then you're kind of stuck with, okay, what do I do with this? But then there's people like you and like Monish Pabrai, someone I've talked about a lot on the show, where somehow they just read between the lines. Mm-hmm. But then, you hit it on the head, because I always thought, okay, these discounted cash flow and net present value models, like, maybe this is because I'm a simple guy, but like this is kind of obnoxiously overrated. And then you hit it on the head, because in the book you said it's impossible to predict profits beyond a few years with accuracy. And even if you could, small changes in discount lead to large a difference in net present value. And so, like in my simplistic mind, when I read, I know we're getting technical for capitalizers, so buckle up. When I read that, oh my gosh, earnings yield, like that totally makes sense. Yes. Earnings per share over the price, beauty. Is it really that simplistic? But then on top of that, what would you say are a couple filters, if you would, to add, like revenue growth, net income growth, margin, etc.?
Sure. Well, let's remember the framework that I outlined in the book that you mentioned, which is BMP. Yes. So it stands for Business Management Price. Yes. And it's not called BMP, just because it sounds better, BMP. It's called BMP because that's the order in which that I personally and I recommend you consider things. So you're now talking about the P, which we can definitely talk about. But the place to start is the B, the business quality. If you're in sales, which is the best company, digital company that does, CRM software. If you're in publishing, which is the best publishing software? If you're, just go down the list. If you're in auditing, which helps you work with the large data sets. Mind your niche for the superior business. Find the business that, that's bulletproof, so to speak, and avoid the ones that are vulnerable. And you as a business practitioner will understand that better than an outsider like me, I'm educated, I'm experienced investor, but I'm not in the trenches watching, companies X, Y, and Z compete in the, DocuSign space. Like, I don't really like, but if you're in that space, you get it, If you're in semiconductor space, Intel's toast and, NVIDIA's great. I'm not recommending it. I'm just theoretically saying
Sure.
people who are in those niches understand that. So start with B and find a business that's, bulletproof, that's superior. And then move to M, move to management. Is the management competent? Are they going to screw up this otherwise wonderful business? Are they going to lead it in other less good directions? Are they going to make stupid acquisitions? Or are they going to focus like a laser beam on what they excel in? So you check the B box, you check the M box, and I go through this in systematic fashion in the book for those who want to learn how to do it. So check the B box, check the M box, and then you get to the price. Price is the last variable. It's a very important variable, but unless you have a good business and a good management team, in my experience, it's not worth messing with.
Sure. And we will get into BMP a little bit more in a moment. And so, like, going off of the P, so, because there's all of these different metrics out there.
Yeah. So I'll answer your early question with that
Sure.
rather lengthy preamble. It kind of is that simple, Chris, that earnings yield is the best metric because, we're all familiar with a bond. We're all familiar with, I go to the bank and, well, for a while it was 0%, but now my bank is offering me 3% interest, which, I'm super happy about after zero rates. So 3% is decent compared to 0. But a stock, you can kind of think of a stock, Buffett calls a stock a bond, but with an expanding coupon. And that's an interesting statement. And what does he mean by that? He means that if you pick a good B, a good business, the earnings will grow. So the coupon, the interest rate, so to speak, that you get on that investment will grow. So let's say you have a company that is earning $1 and the stock is trading for $15. So the PE is 15 times. But if you flip those numbers, it's a better way to think about it because it puts it on the plane of a bond. So 1 over 15 is in rough terms 7%. So you say to yourself, here's this good business that I like, that I know is a superior business from my experience. It's well managed, and I'm starting at a 7% yield. In point of fact, you're not getting that money because the company has a decision as to whether they can reinvest that 7% in their own business, dividend it out, in which case you are getting a portion of it, buy back stock. But theoretically, it's very useful to say, for every $15 I'm investing, I'm theoretically earning, as a partial owner of that business, $1. So my entry yield is 7%, which is more than twice as good as my bank yield of 3%. And that $1, because it's a superior business, is going to grow over time, right? If company XYZ, I think, is in a superior place and can grow over time, in time it will earn $2, and $2 over 15 is a 14% yield. So this is the way you should think about it. I'm going in at a yield of X, and because I'm confident in the business's position, over time that yield is just going to grow. So that's what Buffett means by it's an expanding coupon, right? It's an expanding coupon. bank coupon doesn't go 3, 4, 5, 6, 7. It just stays at 3 unless they raise rates. But
Sure.
you follow what I'm saying.
Right.
So that's the way in some ways it really is that simple.
Capitalizers, this episode is sponsored by the best-selling book, Capitalize Your Finances, the how-to framework that takes you from compoundingly clueless to monetarily magnificent. Regardless of where you're at in your financial life, whether you're just beginning to express interest and commitment to your personal finances, at the pinnacle of your career, winding down into retirement, or thinking about your legacy for future generations, this book walks you through every step of the way so you can succeed on your terms and with your own values and passions guiding you. After reading this book, you will officially have Christopher A. Panayotou, the Cap in Capitalize, in your back pocket, guiding you in detail through every step of the way so that you can take charge of your finances, not the other way around. Head on over to Amazon.com today and start capitalizing your finances to the fullest with this incredible book, Capitalize Your Finances, the how-to financial framework that takes you from compoundingly clueless to monetarily magnificent. And now, back to the episode.
Sure. And you also mentioned going back to bonds. So, and one last question before we go into some of the fun stuff, the day-to-day. You mentioned 5% earnings yield is kind of the minimum. Like, hey, I that's what I need to earn.
Yeah.
And in for long run, which I totally get that.
You need to start at 5.
Right.
Start at 5.
So today's interest rate environment, how has that changed for you, if at all?
Yeah.
Because we're at a point where 6-month Treasury bills, as of this recording, it's almost 5.
Yes.
Which is crazy.
Yes. You know, I had a feeling that rates would rise as I was finishing the book. So I did have a think as to whether I should redo that. And I really don't think that I'm really still very comfortable with 20 times or 5% for a beginning entry yield. I'm really fine with that. Yes, short-term rates are 4.5, but I don't think they're going to stay like that forever. I personally don't think we're in a sort of systemic 1970s kind of inflation thing where, the only thing that would cause me to rethink my 5% entry yield would be a sustained period of higher rates, which I don't think we're in for.
Sure. Well, and when I thought about that as I was reading your book, it's the whole idea. So like when I wrote mine, it was I'm a big football fan, so you kick the field goal. On one side of the goalpost is the art, the other side is the science. Mm-hmm. And if you sway too far one way, you miss opportunity and vice versa. Well, it's no different than when I was reading your book. It resonated so well because once you understand the framework of what BMP is, then you can kind of dance between the goalpost and pivot, and you conceptually get the idea of, okay, it's all relative.
Yes, that's the way the framework is designed to be used. It's a framework. It's not a rigid, set of, thou shalt this and thou shalt not that. I've gotten questions since the book came out, about along those lines. I'm like, just use it as a framework. It's meant to be flexible and supple. It's not dogmatic.
Sure. Well, in again, if I say how much I love BMP one more time, I think everyone is going to just shoot me in the face. But it's tremendously easy to understand. It's also extremely profound. One question I had for you, not only managing BMP, but just like investing process for people looking to get into investing. So let's assume you've already bought a company, whatever it is, and it's solid, it hits the BMP, etc. How often would you say to reanalyze that strategy? Quarterly, semi-annually, etc.?
Oh, I think it depends. I don't think there should be any set date. What I do is, I just keep an eye on my holdings, and I look for changes in BMP. I think the reason that framework appealed to me and the reason it resonates with with you and others is it distills, the many thousands of things that you could think about when you're thinking about investing into three variables, and it's simple without being reductive. It's simple without being simplistic. It really boils down the investment process into the three key variables, and that's why it's useful, because otherwise you're going to be wandering around lost in the forest. So
Sure.
So I just keep an eye on my holdings through the lens of those three variables. Hey, is the business getting better? Is it getting worse? Are there new competitors, etc.
Sure.
The management, are they making smart moves? Are their hires good? Have executives left? Is there a new CEO? What is he or she like? Why did they make this acquisition? Does it make sense? And then the price. The market will tell you a different price. So, if it's getting cheap and the earnings yield is going up, then I get more interested. If everything is still good with the B and the M. If the price is going up and it's getting expensive, then it's maybe time to think about selling some. So none of these variables are lend themselves well to a rigid schedule. You just have to sort of keep your eye on it, and every now and then something changes in the B, something changes in the M, something changes in the P, and you gotta reevaluate. But it's not taxing. It's manageable.
Sure. Taxing could have been a pun for those who are like deeply financially literate, but obviously I know. Here's the thing: I'm going to be a dad in as of this recording in 17 days.
Wow.
So I got to start the dad jokes now because
Yeah,
it's not going to
right,
get
right. Very good.
Obviously you're a professional and you analyze your portfolio daily, as you stated. Being a bit more specific, I'm curious, what does an average day look like for a successful investor like yourself?
Well, it's kind of like what I said at the beginning, Chris. It's a mixture of reading and talking. So, I'll sit around and I'll read financial statements. I'll read regulatory filings from my companies. I'll read newspaper articles and magazines. I subscribe to trade journals of sectors that I'm interested in. So I read technology journals. I read aerospace journals. I read insurance stuff. So it's a lot of reading just so you have that deep sort of sedimentary layers of understanding of your industries and your companies. And then, I get on the phone. I'll talk to my companies, but more importantly, I'll talk to my sort of network of sources. As a journalist, you're taught to cultivate a network. So you're sort of like, the cops or the spies that you see on the shows. It's really true. You have to have a network of people. So you say, well, I saw that this company's doing X. What do you think of that? And then you call up another guy or woman and you say, I saw that, this company has said this. So what do you think of that? And so you're constantly sort of poking around. And then, of course, there's new research. You say, okay, well, this company looks interesting. So, let me talk to the company. Let me talk to my network of sources about these people. Let me talk to the people who do business with them. And then, of course, not infrequently, I get on the road and actually visit the companies, because then you see them, in their habitat, so to speak. And
Right.
they're much. You can learn things by going out and looking at it. Peter Lynch, the great investor from the 1980s, said, that's kicking the tires. You go out and kick the tires.
Yes.
Yeah. So.
Well, and speaking of Peter Lynch, not to interrupt you, but
Yeah.
One of the things I fell in love with about Peter Lynch when I first started reading about investing in general is he's very much like you. I don't know how much inspiration you got directly from him, but I see a lot of the way that he writes and the way that you write, which is a tremendous compliment.
It is a tremendous compliment, and I read his books as I was getting ready to go on to Wall Street, and they were a great inspiration. So, yes, I'm very flattered by that. Thanks.
Yeah, absolutely. Well, and he's also a curious. He's the one. I don't want to say the only person, because I'm sure there's other people out there that I'm just not aware of, but out of everyone that I've studied, he's the one that I can't quite put my finger on how he did. Because you look at like Warren Buffett, he sits in his office, blinds are closed, don't bother him, reads all day. You look at Monish Pabrai, who has openly said, I get to the office, I take a guilt-free nap in the middle of the day, I have afternoon tea, right? And even Guy Spear, who's another one I look up to, he, I think, has a similar path in the fact that he brought on a lot of people and then he's like, this isn't going to work.
Yeah.
Let's go back to our own thing.
Yeah.
But Peter was the one that built up this juggernaut.
Yes.
And I that's the one that I can't quite put my finger on it, but I love how he spoke, just like if I worked for him and I was doing something stupid, I think he would just kindly say, like, as a fatherly, like, / best friend, like, what are you doing, you idiot? And then just like, this is what you need to do. It's just it's very common sense. But you mentioned like printing out filings. Do you print out the full filings or do you read them on the computer? I had to ask.
Well, I do a mix. That's my
Holy cow! Yeah.
Current. So there are actually some still physical annual reports.
Yes.
That I get. I read this one on the plane. I asked them to send me the annual report, and they did. And I read it on the plane, and I made notes, and it was much better than doing, printing it out. But then I do also print out stuff. It's a mix. Okay. I take some notes, handwritten, but then I also write on the computer. So I'm kind of a hybrid.
You're a hybrid. Mm-hmm. You are a hybrid. Mm-hmm. So when you mentioned like calling the investment companies or the investments themselves. So are you calling investor relations and saying, "Hey, send me this documentation"?
Yes.
I love that.
Oh yeah.
I absolutely love that.
Oh,
So one mind-blowingly interesting fact that you slapped on everyone, especially me, in the book, was the approach of analyzing certain businesses' expenses in calculating true profit, in particular, research and developing in marketing. So use some examples in the book. And if you guys haven't, that are listening, put two and two together, you need to buy this book. If not, what are you doing?
Thank you.
But you use some examples in the book of comparable company revenues to match certain expenses to get a true apples to apples. But let's say that there isn't a comparable business out there. So from your judgment call, would it be a viable option to say amortize research and development in marketing numbers by an estimated 20 to 30 years, or said more simply, basically divide that number by 20 or 30 to get what you think would be a more appropriate expense number for discovering the true profit of the company?
Well, you're really getting into the weeds, Chris, and especially since you're not a practicing investor, I'm very I'm impressed, I have to say, that
thank you.
That you took such a detailed approach. But I would back up a minute and say, thanks for recommending that people read the book. I did write it for both professionals who are dealing with these kind of in the weeds type issues, but I also wrote it for amateurs who just want a sort of general lay of the land, like someone who's working with a financial planner. Like, they should read the book, in my opinion, because it talks about big trends in the stock market. It talks about value investing and how value investing, doesn't see tech as attractive, because tech always looks expensive from a value investing perspective, but tech is a mega trend that everyone would agree is here to stay. It's good just to get a good sense of the trends going on in the market if you're investing at all, even through somebody else. But I mean, those adjustments that you're talking about, those in the weeds adjustments you're talking about, are my sort of technical attempt to resolve the central paradox in the book, which is that value investing over 100 years has worked, but it hasn't worked with regard to tech. Tech always looks expensive. Amazon I think I say in the book, Amazon's 20-year average price to earnings multiple is 150 times earnings.
Right.
Whereas the market multiple is 15 times earnings. So Amazon is 10 times more expensive on a reported basis than the average company. But does that mean Amazon is expensive? No. I mean, Amazon has been a huge winner over the last 25 years, but a value investor would never have bought it if they looked at it through a traditional lens. So you have to make these adjustments that you're talking about, which I run through in the book if people are interested. Right. But to your specific question, I don't think we should make any adjustments to amortization and sales and marketing experience. There's a great guy named Bennett Stewart who invented economic value added, the EVA method. He recommends, amortizing R&D over 5 years, and he recommends amortizing sales expense over 3 years. I mean, those, to my mind, are all reasonable, attempts to tease out value in tech companies. And I predict that in 5 or 10 years, the rule makers, the accounting rule makers, will adjust rules so that tech reality shines through more. Because GAAP accounting was created in the 1930s for U.S. Steel, and Amazon and Google and those guys are not U.S. Steel. So the rules need to be updated. Meanwhile, we need to make adjustments. I don't make the adjustments on the amortization or the sales expense, but I do make adjustments on what their latent earnings power is. I spend a lot of time in the book and in my practice thinking, well, the reported profits of this company are X, but if they were run like a regular company, like Exxon, if they were run to maximize profit today, what would this tech company's profits be? Because it's not fair to compare Exxon or Wells Fargo's profits to tech companies, because as I say in the book, the mature company is like an apple orchard in the fall, and the immature company is like an apple orchard in the spring. So you want to think about the harvest and not look at the size of the apples today, so to speak.
Sure. Well, and it's interesting. It's like the circle of life, because then it just goes back to the full circle of when someone like a Warren Buffett says, "Oh, you really need to know the business." Well, you in this one episode brought okay, know the business, and then this is everything that I mean by that, and then you come back to, oh, that's what you mean by knowing the business. Mm-hmm. Well, it's interesting you mention for financial planning, people with financial planners that obviously have clients, they should go and read that. And I've thought about that because I'm only 31, and so I look at all of the people that I've worked with, and this, most people in the industry are older than that.
Yeah.
And so as David Goggins, the motivational Navy SEAL guy, says, who's going to carry the boat? Uh-huh. And so when all of these people are gone, that's what's been so exciting for me as an investor, an amateur investor, professional planner, to dive in. And so I've told all of my clients to go and snag this. Now,
I appreciate it.
Now, for capitalizers looking to gain intelligence in the investing world, you talked about this a little bit, but what would you say are some of the, of course, other than your book, some of the courses that you would recommend, or books that you would recommend for them to read to get a good foundation?
You mean basic investors just wanting basic knowledge?
Sure.
Well, I say in the book, Understanding Wall Street is a great book. It's a little green book that I read when I first went on to Wall Street. Great primer, just a basic primer. I think Investopedia is a great website.
Yes.
It explains, in very plain English, a lot of complicated concepts, and no BS. So I really recommend Investopedia and Understanding Wall Street. I loved Peter Lynch's books. They were accessible, they were exciting, they were interesting. So I would recommend those, even though, as I say in my book, the winners that he talks about are, almost laughably outdated, Subaru,
right?
Toys R Us. Like, oh my God. Like, that's one of the reasons I wrote the book. Like, his his general wisdom is amazing, but the specifics are like a generation old. So I thought it was a necessary to do another sort of accessible book that talked about the realities of the digital age. And then I guess besides those books, the only other one that really comes to mind is, the great biography of Warren Buffett by Roger Lowenstein.
Yep.
Lowenstein, just called Buffett, The Making of an American Capitalist. And that's really an exciting, inspirational story about how he grew up and came to Columbia University and met Buffett and Graham and became a value investor, and then how his investing style evolved. And, the man is a prodigy. He is the Mozart of our industry, and I don't think there'll ever be another one like him. And so he's worth studying and listening to. And if you get a chance, go to his annual meeting in Omaha every May, at least once. Because you watch him. He's 92 years old, and he sits up on the stage, and people just fire questions at him, and he doesn't know what's coming. And he's like an encyclopedia. It's just, he knows everything. He's just
Sure.
It's quite impressive.
Are you going to be making it out to the meeting this year?
Oh yeah, every
You are.
year. Oh yeah.
Okay. I have yet to go, and depending on how
I was going to say, as a new daddy, I'm not sure I'd bet that you were coming this year.
Yeah, that's a little bit in the gray area, and also because it's in May every year,
Yes.
right?
Yeah.
Which,
Early May. Early May.
Early May. Okay. Yeah, because late May is my wife's birthday and mine, but that doesn't matter.
Yeah. Unfortunately, my wedding anniversary is May 4th, so there's always a little uncertainty as to where my anniversary is going to fall relative to the Berkshire meeting. So.
A May the 4th be with you anniversary.
Yes.
I like that.
Yeah.
Okay.
May the 4th.
Was that planned, or
No.
was that totally?
No, I'm not.
Okay.
Neither my wife nor I are Star Wars people. So, no. In fact, I'd forgotten that it's May the 4th be with you. No.
Okay. Well, now I guess you're welcome, or I'm really sorry because you're never going to forget it.
Right.
Right. What would you say? This is kind of a continuation of the question earlier, but let's say someone professionally wants to do this for a living. What would you say is some of the best advice you would give those people?
You mean like be a stock analyst?
Yeah.
Well, certainly read all those books. I would just start applying. Start applying to investment houses. Most people get their start on what they call the sell side, the brokerage side. That's how I started. So becoming a junior analyst for J.P. Morgan or Wells Fargo is a decent track. I think it's a big misconception that you need to be a specialist in business or finance to do this job. Buffett himself says that I think an IQ of, I don't know what he says, 100 or 110 is sufficient, and anything after that is wasted. Peter Lynch said that his best course in college was not business or finance, it was a course in logic. So, I don't believe that you need to go to business school. I don't believe that you need to take the CFA charter, which is very expensive. I myself took the CFA Level 1, which was my boss at the time, Chris Davis, told me I should take, and he was right. But that was it, CFA Level 1. And then when I was doing my transition from journalism to Wall Street, I just took a couple of accounting classes, 2 or 3 accounting classes at night. Because you do need to learn accounting. Like, accounting is important. Like, you can't just say, "Oh, I'm a business analyst." And like, what's depreciation? What's gross margin? What's cost of goods? What's stock-based compensation? This is the language of business. So you better bone up on accounting. But you don't need to go to business school. You don't need to take any fancy programs. You just need to learn accounting, and then, as Buffett says, start reading annual reports. Start with the A's and end with the Z's, and use Investopedia, use my book, use Understanding Wall Street, use other tools to learn. Like, I don't understand what what does this line in the financial statement mean? Well, look it up. You can teach yourself a lot of this stuff. And then when you get a job, that's when you really start learning.
Sure. So what are you pursuing today that's getting you excited to wake up every day? Like, what are you doing with your time that's futuristic things that you're excited about? What products have you purchased to help with that pursuit? Like, what is the future in store for Adam in 2023 and beyond?
Let's see. Well, I'm always very excited about research. I mean, I love doing research. I've said many times that, if they didn't pay me, I'd probably do it for free. I'm just sort of a natural hunter, bird dog, investigator. So I got my research list for 2023 ready to go. I've got one particular project that I'm working on that is very exciting, that could yield some great new investment ideas. That's a big priority. And then I'll just keep writing. I write for Market Watch online. I write for Fortune magazine. So I'm looking forward to writing more articles and maybe a second book. The writing I see very much as complementary to the investment research, because here again, when you write, you see what you know and what you don't know.
Sure. Well, and I have to ask, how long did it take you to write this first book?
Not as long as you'd think. Maybe 18 months, start to finish.
Okay.
But you have to remember, this is the culmination of 25 years of an investment career, and then 5, 6, 7 years of really deeply thinking about, why isn't value investing reconciling with the new digital economy, and how can I personally reconcile those two so that I can make money for myself and for my clients going forward? How can I take advantage of all the disruptive digital technologies that have come and will continue to come onto the scene, while staying true to the discipline of value investing? So, in some ways, I had already written the book in my head, if you know what I mean. It was just a question
I do, and you say it a lot more, I guess, appropriately and sophisticatedly than I do, because people will ask, like, how long did it take you to write the book? And I go, do you want the literal answer or the real answer?
Right.
The literal was 18 months.
There you go.
But the real answer is 31 years.
There you
and
go.
then somehow you look like a jerk for saying that. But neither here nor there. Wrapping it up, where can capitalizers go to support and find you?
Well, the book is available on Amazon and any other fine bookseller. If people want to talk to me, LinkedIn is a great way to chat. I think that's how you found me.
It is.
I answer queries about that. And then, if people are interested in investing in Gravity, it's invest@gravitypartners.com.
Awesome. Well, Adam, we're definitely going to have you on in 5 years to look back on how accurate this was.
We'll
but
see what changes.
When your second book comes out, please let me know. I'm excited to read it, and we will have to have you on for that as well. And for those of you listening in, thank you as always for tuning in to Capitalize Your Finances. If you have any guests that you think would be enlightening to have on the show, you know the drill. You can shoot me an email, chris@capitalizeyourfinances.com. If you have any questions about today's interview or anything financially in general, you can also give me a call at 253-214-3050. That's 253-214-3050. As always, I'm your host, Christopher A. Paniotti, the Cap and Capitalize. And until next time, keep capitalizing.
You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. We cannot assure the accuracy or completeness of these materials. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. It is important to keep in mind that investments in fixed income products are subject to liquidity risk, interest rate risk, financial risk, inflation risk, and special tax liabilities. Interest may be subject to the alternative minimum tax. Treasury securities are backed by the full faith and credit of the U.S. government, but are subject to inflation risk. Information on investment products is for informational purposes only and does not constitute an investment recommendation or a solicitation to buy or sell the investments described herein. Any investments or strategies referenced herein do not take into account the investment objectives, financial situation, or particular needs of any specific person. No client or prospective client should assume that the presentation or any component thereof serves as the receipt of or a substitute for personalized advice from Capitalize Your Finances or from any other investment professional. Christopher Paniotu is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Capitalize Your Finances, a separate entity from LPL Financial. Adam Seessel and any other individual or company mentioned in this podcast are not affiliated with Capitalize Your Finances or LPL Financial.